Building wealth is very often associated with having a high-paying job or a large amount of starting capital. In reality, the most significant factor in wealth generation is not the amount you start with, but how much time you give that money to grow. This chart showing the net worth of Warren Buffett illustrates the impact of a long time horizon. Buffett started at age 14, yet more than 99% of his wealth accumulated after his 50th birthday. Starting early provides the longest possible exposure to the mechanics of compounding, which serves as the primary driver of financial independence. Data from FinCalWise helps quantify exactly what happens to your savings when you delay that start date. Investing $300 monthly at 7%, starting at 40, yields $268,000 by 65. Starting at 25, reaches nearly $800,000, a $500,000 advantage. Incredibly, stopping contributions after just 10 years at 25 still beats someone saving for 3 decades starting at 35. For investors in their 20s and 30s, this long runway allows for an aggressive strategy, typically involving an 80 to 90% allocation to equities. However, high management fees on active funds can trigger a process of reverse compounding that erodes these gains. The rule of 72 shows that a 3% annual management fee will cut an account's total value in half over 24 years, compared to holding the same investment without that fee. Maximizing your growth potential requires moving aggressively into equities while eliminating the friction caused by high fees. By your 30s, higher income often leads to lifestyle inflation, where increased spending makes it difficult to maintain a high savings rate. To combat this, you can use a strategy of incremental contribution scaling. This chart from Standard Chartered shows a plan that starts with a modest 5% savings rate and increases it by just 1% each year. Despite small initial contributions, this gradual ramp-up builds a final portfolio worth 13 times your ending salary. This grid tracks various asset classes over 5 years, showing that no single sector or stock consistently leads the market. For the average investor, manual stock picking is a flawed approach. Instead, growth can be managed through low-cost passive index funds and automated robo-advisors. These systems use automated rebalancing to sell high and buy low. This maintains your target equity allocation without requiring you to make emotional decisions during market swings. By combining these scheduled contribution increases with rules-based management, you create a system that generates wealth without the need for constant manual intervention. Reaching age 40 marks a shift in your timeline. With fewer years left until retirement, the window to recover from a major market crash has narrowed. Your primary strategy must now transition from aggressive capital accumulation toward capital preservation. This involves dialing down broad equity exposure and rotating into high dividend stocks to provide a defensive buffer against inflation. You also begin increasing your allocation to fixed income assets, which helps create a stable floor for your portfolio. Strategic allocation also means balancing low-yield, stable assets in developed markets with the higher yield potential of emerging market debt. Selective exposure to investment-grade bonds and emerging market assets provides a yield boost while managing the overall volatility of the portfolio. Wealth is built by starting early, with systematic capital increases and de-risking as your timeline shrinks. Ultimately, financial independence is the result of synchronizing your personal risk profile with the unwavering mathematics of time.